There are more than 10,000 mutual funds and 2,000 index funds available in the market today. That's a lot of options to choose from. But how do you decide which type of fund is more suitable for your risk profile? Mutual funds or index funds? That's the question I'm going to answer in this video. I'm going to discuss about mutual funds versus index funds and which one is more suitable for your risk profile. By the end of this video, you'll have a better understanding of the pros and cons of each type of fund and how they affect your risk profile. You'll also learn some resources that you can use to further research and compare mutual funds and index funds. So stay tuned and let's get started. Before we dive into the comparison, let's first define what these two types of funds are and how they differ from each other. A mutual fund is a collection of stocks, bonds, or other securities that is managed by a professional fund manager. The fund manager's job is to select the best securities for the fund based on the fund's investment objective, such as growth, income, or value. The fund manager also adjusts the portfolio periodically to respond to changing market conditions and opportunities. An index fund, on the other hand, is a type of mutual fund that simply tracks a specific index, such as the S&P 500, the NASDAQ 100, or the Nifty 50. An index fund does not have a fund manager who actively picks and trades securities. Instead, it follows a passive strategy that aims to replicate the performance of the index as closely as possible. So what are the main differences between mutual funds and index funds, and how do they affect your risk profile? Let's compare and contrast them in terms of three key factors: management style, investment objective, and cost. First, let's talk about management style. Mutual funds have an active management style, which means that the fund manager actively researches, analyzes, and selects the securities for the fund. The fund manager also monitors the market and makes changes to the portfolio when needed. The goal of active management is to beat the market and generate higher returns than the index. Index funds have a passive management style, which means that they simply follow the index and do not make any changes to the portfolio unless the index changes. The goal of passive management is to match the market and generate returns that are similar to the index. The pros of active management are that it can potentially outperform the market and generate higher returns. It can also adapt to changing market conditions and avoid losses. It can also offer more diversification and exposure to different sectors and regions. The cons of active management are that it can also potentially underperform the market and generate lower returns. It can also incur higher risks and volatility. It can also charge higher fees and expenses, which can reduce the net returns. The pros of passive management are that it can guarantee market returns and reduce the risk of underperformance. It can also incur lower risks and volatility. It can also charge lower fees and expenses, which can increase the net returns. The cons of passive management are that it can also limit the potential returns and miss out on opportunities. It can also be affected by market downturns and losses. It can also offer less diversification and exposure to different sectors and regions. Some examples of fund managers and their strategies are Peter Lynch, who managed the Fidelity Magellan Fund and achieved an average annual return of 29% from 1977 to 1990. Warren Buffett, who manages the Berkshire Hathaway Company and has an average annual return of 20% from 1965 to 2020. And Rakesh Jhunjhunwala, who manages the Rare Enterprises firm and has an average annual return of 25% from 1985 to 2020. These are examples of mutual fund managers who use different strategies, such as value investing, growth investing, momentum investing, or contrarian investing. They also use different tools, such as fundamental analysis, technical analysis, or quantitative analysis. Some examples of index funds are the Vanguard 500 Index Fund, which tracks the S&P 500 index and has an average annual return of 10% from 1976 to 2020. The A-Shares Core S&P Total U.S. Stock Market ETF, which tracks the S&P Composite 1500 Index and has an average annual return of 9% from 2000 to 2020. and the Nippon India Nifty 50 Index Fund, which tracks the Nifty 50 index and has an average annual return of 12% from 2000 to 2020. These are examples of index funds that use a simple strategy, which is to buy and hold the securities that make up the index. They also use a simple tool, which is to track the index's performance and composition. Next, let's talk about investment objective. Mutual funds have a market-beating investment objective, which means that they aim to generate higher returns than the index. They do this by using various strategies such as value investing, growth investing, momentum investing, or contrarian investing. Index funds have a market-matching investment objective, which means that they aim to generate returns that are similar to the index. They do this by using a simple strategy, which is to buy and hold the securities that make up the index. The pros of market beating are that it can offer higher returns and reward the investors for taking higher risks. It can also provide more satisfaction and excitement for the investors who enjoy the challenge and thrill of beating the market. The cons of market beating are that it can also result in lower returns and penalize the investors for taking higher risks. It can also cause more stress and frustration for the investors who suffer from the disappointment and regret of underperforming the market. The pros of market matching are that it can offer consistent returns and protect the investors from taking higher risks. It can also provide more peace and comfort for the investors who prefer the simplicity and reliability of matching the market. The cons of market matching are that it can also limit the returns and prevent the investors from taking higher risks. It can also cause more boredom and indifference for the investors who lack the interest and enthusiasm of challenging the market. Finally, let's talk about cost. Mutual funds have a higher cost, which means that they charge higher fees and expenses to the investors. They also incur higher taxes, which reduce the net returns. The main components of the cost are the management fee, which is the fee paid to the fund manager for managing the fund, the sales charge, which is the fee paid to the broker or distributor for selling the fund, the operating expenses, which are the expenses incurred by the fund for administration, accounting, auditing, legal, and other services, the turnover ratio, which is the percentage of the fund's portfolio that is traded each year, and the tax efficiency, which is the percentage of the fund's return that is retained after paying taxes. Index funds have a lower cost, which means that they charge lower fees and expenses to the investors. They also incur lower taxes, which increase the net returns. The main components of the cost are the management fee, which is the fee paid to the fund provider for tracking the index, the sales charge, which is the fee paid to the broker or distributor for buying or selling the fund, the operating expenses, which are the expenses incurred by the fund for administration, accounting, auditing, legal, and other services, the turnover ratio, which is the percentage of the fund's portfolio that is traded each year, and the tax efficiency, which is the percentage of the fund's return that is retained after paying taxes. Some examples of low-cost and high-cost funds and their net results are the Vanguard Total Stock Market Index Fund, which has a management fee of 0.04%, an expense ratio of 0.04%, a turnover ratio of 4%, and a tax efficiency of 98%. The HEFC Top 100 Fund, which has a management fee of 1.75%, an expense ratio of 2.08%, a turnover ratio of 28%, and a tax efficiency of 88%. The A-Shares Core S&P Total U.S. Stock Market ETF, which has a management fee of 0.03%, an expense ratio of 0.03%, a turnover ratio of 3%, and a tax efficiency of 99%. And the Angel One Blue Chip Fund, which has a management fee of 2.25%, an expense ratio of 2.54%, a turnover ratio of 65%, and a tax efficiency of 85%. These are examples of low-cost and high-cost funds that have different net results after accounting for fees, expenses, and taxes. To summarize, mutual funds and index funds have different characteristics that affect your risk profile. Mutual funds have an active management style, a market-beating investment objective, and a higher cost. Index funds have a passive management style, a market-matching investment objective, and a lower cost. Depending on your risk profile, you may prefer one type of fund over the other. Your risk profile depends on factors such as your age, income, goals, time horizon, and personal preference.